Goldman cutting its forecast for the 10-year yield today, saying we may have already seen peak rates in this cycle. Bob Pisani is down at the NYSE with all the details. Hey, Bob.
Hello, Melissa. Good to see you as always. Goldman had a report out revising down their global yield forecast for 2019. Now, they cited weakness in the global growth data, a poor risk sentiment, and tighter financial conditions. All that, Goldman says, has led markets to reconsider just how much farther central banks can really raise rates globally. You put it all together here, Goldman now believes 10-year yields have peaked for this cycle. They have revised their yield forecast downward right across the globe. So the most important revision is right here in the United States, where they've downgraded their outlook in general. The U.S. forecast is now 3% yield for the 10-year by the fourth quarter. That's 50 basis points lower than the old forecast of 3.5%. They also dropped it significantly in Canada, 2.4% now. That's lower by about 50, 60 basis points than the old 3% forecast. There's more modest revisions elsewhere, Germany, the UK, and Japan. In Germany's case, the downward revision is only 15 basis points lower to 0.65%. Now, why the more modest downward revisions in Europe? The lower growth expectations there, the ample supply of bonds, and the end of bond purchases by the European Central Bank all limit how far yields can move down, Goldman says. Importantly, while Goldman continues to expect the yield curve to flatten in the United States, they do not expect the 530 curve to fully flatten. So, Melissa, some very interesting comments from Goldman. Back to you.
Absolutely. Thank you, Bob. Bob Pisani at the NYSE. Well, financials will face the music next week as earnings kick off, and our next guest says it's going to get ugly out there. Let's bring in Todd Gordon of tradinganalysis.com. He's over at the Plaza with more. Hey, Todd.
Hey, Melissa. First, to set up the current environment, which financials continue to be a major headwind to any kind of recovery, let's look at the 10-year yield and the XLF in blue. So this is the financials ETF. Traditional global macro relationships would say that bonds or bond yields will lead stocks. What's interesting is we're seeing the reverse happen. XLF in blue, you'll see bottomed first, then began to move up. 10-year yield was some period later. Same thing up here at the top. We had XLF topping, then yields beginning to top, moving lower. Personally, I do think yields continue to push down in kind of a risk off safe haven kind of trade. I'm long TLT, so I think this underperformance in the financials continues. So as we look at the XLF in isolation here, we could see that we have a serious period of underperformance here. Financials continue to be a major weight on this market. We have a huge kind of 2017-18 shelf here. We've got a line here. We've got a line here. There's a lot of wood to chop from old lows, which were formerly support, now acting resistance. On top of that purple line right there is the 50-period MA. As a technician, when you get a confluence of technical levels coming together, it just adds extra conviction to the trade. So I think 25 is going to be very significant heading into earnings starting on the 14th. JP, arguably the strongest financial out there. Again, that same kind of concept of a broken shelf of support that should have held, didn't, broke, now offers resistance, is right around here at about the 103, 104 level. Again, one of the strongest financials out there, but again, 50 MA matches up with this old support. Anybody who's caught long here would be happy to get out of break even, creating that synthetic resistance level with confluence in the 50 MA. So earnings better be pretty strong if we're going to continue to squeeze on up. But me, I'm personally short the market. I'm nervously short, and financials, I think, are helping that trade on the downside.
You're short the overall S&P 500, Todd?
I'm short the overall S&P. I've reduced the position here. I'm going up, and if we do start to get any more strength, I will cut that. I'm long the market longer term, but my shorter term trading accounts, I am short with the options market. Nervously short, but technology is moving up. FANG continues to be strong. I think it's the beaten down FANG coming up, heading into earnings. Is that a recovery story? I don't know, but I think that's a major problem.
All right, Todd, good to see you. Thanks. Todd Gordon, tradinganalysis.com. Interesting call in terms of JP Morgan. We had Jefferies come out downgrading the stock today to a hold rating, basically saying that it's going to be an outperformer in its group simply because the earnings revisions for its peers will be worse. It's not exactly a ringing endorsement for JP Morgan's outperformance of the group, Karen.
Yeah, and I love JP Morgan. It clearly hasn't been a great place to be. I mean, it's, this valuation, what is it, about 10-ish times? The yield is north of 3. I don't like to buy anything on a dividend, but think about that. The premier name, the pristine balance sheet, an extraordinary business, right? And to be able to buy it at this price, I don't know. I think the risk reward is very compelling here.
JP Morgan was my all-weather stock yesterday, and that was kind of a crazy thing to do, but I believe that, yes, because it outperforms its peer group. I say this about financials. Easy to attack them. They've underperformed the S&P from last February to the lows by about 11.5%. During this period where yields have been plummeting, and they've obviously rallied back over the last couple of days, but the banks outperformed the S&P from mid-December to this point. And that tells you something about where they could outperform now.
I love the banks here. I actually,
banks.
yes,
You're
because
not
I happen.
joking?
No, I'm not joking.
Okay.
No, I really love the banks because I happen to think
What
that
does
we're at
BK
the
think,
early
though?
stages. What's that?
What does BK think?
BK loves them too. He'll buy them twice. That's how much he loves them. But I think we're at the early stages of the Fed changing monetary policy. They do not want a flat yield curve. So they're going to change their policies so the yield curve steepens, and that's going to be fantastic for banks. So I like them, especially the ones that are trading below book value.
Well, one of them is trading significantly below tangible book is Citi. I mean, Citi reported middle of October, tangible book was $61.91. Now you look at it, it's trading with a $55 handle. The banks are trying to tell you something. We're not at financial crisis levels, but Citi trading where it is, Goldman Sachs, which is a story unto itself, trading where it is, it's telling you that things aren't as rosy as they seem. So although JP Morgan is best, and no question about it, at what point does it price a tangible book just so out of sync with the rest of the space? Does it continue to widen, or does JP Morgan sort of start to get cut? That's the question to me.
I'm not as focused on price to tangible book as I am to earnings, right? So to me, the different Citi at one point I thought had more upside, right? But
In a global economy, that kind of a thing? I mean,
just there was priced cheaper, the PE was cheaper, the price to book was cheaper, all of that. But now the yield is about the same. To have JP Morgan at 10 times and Citi at 8.5 times isn't quite enough that discount isn't enough to overcome what the premium valuation that JPM deserves.